Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial secrets of the business world. Today, we're diving deep into Sunrise Realty Trust's latest SEC filing, and let's just say their debt situation is interesting. This isn't just another quarterly report, it is a snapshot of a company navigating growth. And sometimes that means taking on a lot of debt. We're going to look at their numbers, see where the money is coming from and going, and figure out if this is a smart move or a risky gamble. Before we dive in, if you love getting these no-nonsense insights from SEC filings, make sure you hit that subscribe button. And for more direct access and to chat about these filings, join our Discord community linked in the description. Scroll Sunrise Realty Trust, Inc. Table of contents to scroll. Alright, let's get into Sunrise Realty Trust Incorporated, or SUNS. They've just filed their quarterly report for the period ending the 30th of September 2025. And it paints a picture of a company that is actively expanding its real estate lending business. Let's start with their balance sheet. On the asset side, their loans held for investment at carrying value net shows a pretty significant jump. As of the 30th of September 2025, it is over $250 million, up from about $130 million at the end of 2024. This means they've been busy originating or acquiring a lot more loans, which is good if they want to grow. However, their cash and cash equivalents has dropped dramatically from almost $185 million at the end of last year to just over $5.5 million by September 2025. This steep drop in cash suggests they've been actively deploying it into those loans, a strategy that can be very profitable if the loans perform well. Now, let's look at the liabilities. This is where things get really interesting for SUNS. Their line of credit payable is substantial, sitting at over $67 million as of September 2025, and it was even higher at $123 million at the end of 2024. They also had a significant line of credit payable to affiliate of $75 million at the end of 2024, though this appears to have been paid off. All this borrowed money is fueling their loan portfolio growth, but it also means they have a lot of debt to manage. Moving over to their income statement, their interest income has seen a massive increase. For the first 9 months of 2025, it is nearly $19.2 million compared to just over $7.2 million for the same period in 2024. That is almost a 166% jump, which directly correlates with their expanding loan portfolio. They're making a lot more money from the interest on their loans. But with more loans comes more debt, and that is reflected in their interest expense. For the 9 months ended September 2025, it is almost $2.9 million, a huge increase from a mere $43,197 in the prior year. That cost of borrowing has gone up substantially, which makes sense given their increased reliance on credit lines. Despite the rising interest costs, their net interest income, that is the money they make after paying interest on their own borrowings, is up from about $7.2 million to over $16.3 million for the 9-month period. This shows that for now, the income from their loans is outpacing the cost of their debt. Their earnings per common share for the 9 months ended the 30th of September 2025 is $0.82 basic, up from $0.74 in the prior year. This indicates they are becoming more profitable on a per-share basis, which is generally a positive sign. Looking at shareholder equity, we see a significant increase in additional paid-in capital. For the 9 months ending the 30th of September 2025, it is over $187 million, a big leap from $115 million at the end of 2024. This primarily comes from their January 2025 stock offering, where they raised a substantial amount of capital, $71.3 million net. This strategic move helped them fund their loan book expansion without solely relying on debt. However, you'll notice their accumulated earnings deficit is still in deficit, currently at a negative $2.5 million. This means that overall, since they started, they've accumulated losses, even though they're currently profitable. This is not uncommon for a growing company that is heavily investing in new assets. Now, let's dig into their cash flows. For the 9 months ended the 30th of September 2025, they used about $1.9 million in operating activities. This is a shift from the prior year when they had about $2.7 million provided by operations. The change is mainly due to the increased interest income they collected, which offset a lot of their operating expenses. Their investing activities show a significant outflow, with over $105 million used to fund loans in the 9 months of 2025. This is a substantial increase from the prior year, confirming their aggressive loan origination strategy. Financing activities show a large outflow of cash, Nearly $71.6 million used in the 9 months of 2025. This is a big flip from the prior year when they had over $130 million provided by financing activities, largely due to their spin-off from their former parent company. The current year's cash outflow from financing is driven by significant repayments on their revolving credit facilities, which outweigh the new borrowings. Let's briefly touch on the notes. Under loans held for investment at carrying value, they detail their loan portfolio. As of the 30th of September 2025, they have 13 loans totaling over $252 million in principal. A large chunk of this, nearly 96%, has floating interest rates, which is good in a rising rate environment as their income adjusts upwards. They also mention their current expected credit losses reserve, or CICL reserve, which is about $432,000. This is a provision for potential loan losses, and it's 0.17% of their total loan portfolio. It seems quite conservative, suggesting they have high confidence in their borrowers or their risk assessment. Under their debt notes, we see details about their credit facilities. Their main revolving credit facility has been expanded now, with commitments up to $140 million and matures in November 2027. The interest rate is tied to SOFR plus a spread, currently around 7%. They also have the SRTF credit facility, which is an unsecured line of credit from an affiliate with a $75 million commitment. It is interesting that they had no outstanding borrowings on this affiliate loan as of September 2025, suggesting they might be prioritizing their other credit lines, or perhaps this affiliate line is less attractive or has reached its capacity. The related party transactions section is always a good place to check for potential conflicts or unique arrangements. Suns is managed by Sunrise Manager LLC, which is partly owned by key executives like Leonard M. Tannenbaum, the executive chairman. They receive management fees and incentive compensation. For the 9 months ended September 2025, management fees totaled about $1.4 million and incentive fees were around $374,000. They also had a fee waiver related to their January 2025 share offering, where management fees were waived for a period to help the company utilize the capital raised. Their dividends and distributions show they declared dividends totaling $0.9 per S-share for the first 9 months of 2025, paid out across 3 installments. This demonstrates a commitment to returning value to shareholders, which is a key factor for REITs for the 9 months of 2025. Total dividends paid were over $12 million. Suns operates as a single institutional lending segment, which is typical for a company focused on a specific financial strategy. They highlight that a significant portion of their interest income comes from a concentrated group of borrowers. For the 9 months of 2025, 6 borrowers accounted for about 83% of their consolidated interest income. While concentration can amplify returns, it also increases risk if any of those major borrowers face difficulties. Now, for the subsequent events section, which covers things that happened after September 2025. In October 2025, they entered into 2 new senior secured mortgage loans for industrial properties, one in Doral, Florida, and another in West Palm Beach, Florida. The company committed $9.4 million to the Doral loan and $16.2 million to the West Palm Beach loan. They also entered into a $45 million senior bridge loan for a retail property in Houston, Texas, where they committed $30 million. These are significant new investments showing their continued aggressive expansion strategy beyond the 3rd quarter. These new loans carry interest rates tied to SOFR plus a spread, which is consistent with their existing portfolio. So, what is the big picture here for Sunrise Realty Trust? Incorporated Suns, on the positive side. Suns is clearly executing on its growth strategy, significantly expanding its loan portfolio, and seeing a corresponding surge in interest income. Their move to raise equity capital in early 2025 was a smart strategic play that helped fund this expansion. The company's focus on floating rate loans is also well positioned in the current interest rate environment, allowing their income to grow as rates rise. They're also returning capital to shareholders through dividends, which is a positive signal. However, the rapid increase in debt, particularly through credit facilities, is a significant risk factor. While their net interest income has grown, the cost of servicing that debt has also ballooned. The concentration of their interest income with a few large borrowers is another area of concern. If any of these key borrowers falter, it could have a disproportionate impact on Suns' profitability. The company's decision to deploy almost all of its cash into loans, leaving very little on hand by September 2025, might also be a point of concern for risk-averse investors, especially given the current economic climate. In conclusion, Suns is in a high-growth, high-leverage phase. They are making bold moves to expand their loan book, which could lead to substantial returns if managed correctly. But the increased debt burden and borrower concentration mean they are treading a fine line. Investors should watch closely how they manage their debt obligations and how their key borrowers perform. That is our breakdown of Sun's latest filing. What do you think about their aggressive growth and borrowing strategy? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community for more in-depth discussions. Link is in the description. Thanks for watching. See you next time.